Martin, I don't think at this point you're seeing any more than the usual wall of worry that equities investors normally get paid to hold. I would almost make the other argument that, like you said, there is a lot more policy certainty on tariffs at this point. The single biggest hurdle would have been a US China breakdown. And you notice no one's talking about that. A US China trade detente at this point is locked in place. Mexico, Canada, China, Europe, those are the four economies, and only those four economies that matter when it comes to global macro from a trade standpoint. And as long as there is no breakdown on European tariffs, I think the markets are going to look past any issues with Japan, like the US equity markets at least. Oil, you mentioned oil. You would need oil to go up, to $110, $120 a barrel and stay there for me to be worried. And I just don't think that's going to happen.
All right, fair enough. And we have to note that even with all the volatility, right, those high prices, we had oil up north of 80 during the last couple of weeks or so, but that did not last. It didn't stay there, is your point. So you're pretty constructive and positive and even bullish U.S. equities. You've got the S&P at a little over 6,000 by the end of the year, 6,050. We had another guest as optimistic as 6,500 and then 10,000. By the end of this decade. That is 5 years out. Are you that optimistic?
Well, I'm lucky if I get the next 3 months right. So I'm not going to try and forecast 10 years out. But,
okay.
but there is a theme here, which is, we spend so much time, so much ink, so much newsreel on tariffs and the tax bill when it comes to the United States. And yet the single biggest story, honestly, is what I think of as the AI dividend. The fact that we are moving away from the compute side of things to the inference side of things. AI is now starting to drive operational efficiencies. It's now starting to give you operating leverage. It's now starting to increase your margins and your earnings, at least for big tech. And that's just going to broaden from here. So, God bless whoever made that forecast. I'm not brave enough, but I can see where he or she is coming from.
Okay, so the AI dividend, let's talk a little bit more about this because, these hyperscalers, they need to start making this money back. The $300 billion they've invested, right? Their business model is totally opposite of China's post-DeepSeek and the explosion going on there. For them, it's going to be like EVs, right? Damn the profits. I want dominance, control. I want market share. The U.S. hyperscalers, they need to make money. Are they on track to do that right now? Because, you were talking about enterprise. I think that low-hanging fruit is already starting to be picked. In terms of inference, I think where they're going to have to deliver is front-facing with consumers, yes?
So you're right, number one. But number two is, so far, they are on track. So big tech earnings, after the first quarter's earnings prints are over, are up about 27% year over year. Quarter over quarter, big tech is up about 11 to 12%. Annualize it, you're on pace. You can't annualize, but you're on pace for a 50% earnings boost. One of the things to remember, Martin, is that even as you and I and everyone in the markets, right, looked at eye-popping valuations for big tech, 12, 18, 24 months ago, the fact is that tech earnings have grown so strongly that even with all of the money that they are spending, the hyperscalers in particular, their multiples are now lower than they were a few months ago. Big tech is running at 27.5, 28. We were at 31 not that far ago, before April, obviously. I think we can get there again.